Welcome to the deep dive. Today, we're really immersing ourselves in a single, frankly, utterly chaotic day on the market, October 14th, 2025.
Quite a day to pick.
Right. Our mission today is to unpack this trading session, our, specialized intelligence briefings. They described it as being fractured by competing narratives.
Fractured is a good word for it.
Think about that for a second. The sheer, schizophrenia of it. How can the market simultaneously celebrate fantastic corporate earnings?
Really strong earnings, too.
Exactly. And at the same time, execute a sharp, almost fear-driven sell-off. It resulted in this deeply, profoundly mixed close. It just doesn't quite add up on the surface.
It doesn't.
We're your guides today. We've sifted through the comprehensive daily market summaries, the intelligence briefings, basically the same documents top money managers were glued to minute by minute.
Yep. Trying to make sense of it all in real time.
We want to understand how these institutions processed everything at once. You had this geopolitical shockwave, stellar Q3 reports coming in, and central bank commentary all hitting the tape. So this deep dive is your shortcut, hopefully, to understanding what really mattered that day.
And that framing, I think, perfectly captures the core conflict, the internal battle that defined this session. What we saw on October 14th was just a textbook struggle, wasn't it?
Right.
Between the immediate positive fundamentals,
earnings.
right, the actual results,
Yeah.
versus this rapidly deteriorating macroeconomic and geopolitical outlook. The market had, every reason on paper to rally based on those earnings. And yet it found these overriding, almost structural reasons to panic in certain areas.
So the big question becomes...
A central question for every investor right now, I think, is this.
Yeah.
How do you accurately price these conflicting high-stakes risks in real time? It's incredibly difficult. You've got companies reporting what they did back in Q3, which, as we said, was often great. But then you have their CEOs, sometimes in the same earnings call, warning about what they fear might happen next year.
That disconnect.
Exactly. And layer on top of that, the data is incomplete because of the government shutdown, right? And the news cycle is just governed by this instant geopolitical rhetoric, tweets, headlines.
Yeah, minute by minute.
So the task of setting a fair price for anything becomes, almost impossible sometimes.
Okay, let's dig into that unusual close then. Because when you look at the final numbers, it doesn't just look mixed. It looks like, a genuine separation, like two distinct economies or maybe two vastly different investor outlooks operating simultaneously.
A real tug of war. That's a good way to put it.
Let's start with the hard numbers because they really define this paradox. You had the Dow Jones Industrial Average weighted towards those stable industrial blue chips. It actually managed to post solid gains. Finished up plus 0.44%.
Which is over 202 points.
Yeah.
Not insignificant.
Right, closing at 46,270.46. So if you were just holding Dow stocks, maybe you walked away feeling, okay, even pretty good about the day.
Relatively speaking, yeah. But if you held a broader index, the story changed pretty dramatically. The S&P 500, which, we often see as the best proxy for the overall U.S. economy, it actually closed down slightly, lost 0.16%, or about 10.4 points.
And it tried to climb back, didn't it, intraday?
Oh, yeah. It spent most of the day fighting to get out of the red, clawing its way back, only to just sort of fall back in the final hour of trading.
Oof. And then there's the tech story, the NASDAQ composite.
Yeah, that index took the real structural beating, you could say. Closed down a full 0.76%. That's shedding nearly 173 points.
So when you see that kind of split Dow up solidly, NASDAQ down pretty hard, that's the absolute definition of a split tape, isn't it?
It is. It tells you the market isn't just selling off indiscriminately. It's not panic selling everything. It's surgically removing exposure to very specific kinds of risks.
But, the close is really only half the story here. The real narrative, the scary part, is the intraday action. This day was just a complete roller coaster. It started with a shock even before the opening bell.
Oh, absolutely. It began with genuine broad-based risk aversion.
Oh.
Overnight, news broke about these highly specific, targeted retaliatory trade measures coming out of China.
Okay.
And pre-market, you saw stock futures instantly price that in. Global conflict fears spiked. We saw the S&P 500 and the NASDAQ comp futures pointing down like 1.5% before the open.
Wow, 1.5%.
Yeah, and the Dow futures were set to drop over 383 points. It really looked like it could be the beginning of a full-blown rout.
That kind of gap down pre-market often sets a really negative tone for the whole day, right? Signals capitulation, maybe? So what stopped the bleeding? What anchor did the market find mid-morning to stage that, furious reversal attempt?
It was a powerful combination, even if it turned out to be temporary. Two distinct factors, really.
Okay.
First, as we mentioned, those strong earnings reports. Specifically, major banks like Wells Fargo came out with numbers that provided a much-needed injection of, let's say, corporate health and confidence.
So good fundamentals from the banks.
Yeah. They suggested the underlying profitability of the financial system was, pretty robust, despite all the global headwinds everyone was talking about.
And the second factor.
The second factor was the policy backstop. You had these dovish remarks emerging from Federal Reserve Chair Jerome Powell.
Ah, the Fed.
He signaled concern over rising employment risks and, crucially, a clear willingness to shift policy if things got worse. That instantly reinforced the old Fed put narrative.
Right, the idea that the Fed will always step in.
Exactly. The idea that the central bank stands ready to support the economy, likely with future rate cuts if needed. And, the prospect of rate cuts is always like rocket fuel for equities.
So that cocktail strong corporate news from the banks, plus the promise of monetary support that was incredibly potent for a while there.
It was. It managed to swing the Dow from being down, 383 points pre-market?
Yeah.
To being up over 360 points midday. That's a massive intraday range, over 700 points.
Yeah, it's incredible volatility. And it's critical, isn't it, to understand which sectors drove that reversal? Because it wasn't tech leading the charge back up.
Not at all. It was the banks like Wells Fargo and the heavy industrials, the Caterpillars of the world, that signaled a flight to sort of domestic stable quality rather than a broad risk-on rally.
But that recovery, it felt fragile even then, didn't it?
Extremely fragile. It was fueled by hope, really, and the promise of maybe future Fed easing.
Yeah.
But the selling pressure, which was heavily concentrated in global tech and especially semiconductors, it never truly went away.
Just lurking beneath the surface.
Exactly. It felt like it was just being held in check, with traders almost actively looking for any excuse, any reason to sell into that rally.
And the market found that reason in the afternoon. What was the definitive trigger? What fractured that fragile piece and sent the S&P back down?
Well, it wasn't fundamental news. It was purely rhetorical, incredibly efficient, and came late in the day. A social media post.
Oh, boy. Let me guess.
From President Donald Trump regarding the ongoing tensions with China.
There it is.
That single post, you could just watch it happen. It caused institutional traders, and importantly, those high-frequency algorithms to just reverse positions instantaneously.
Think about the mechanics of that. The Dow was near its high for the day. The S&P 500 was, slightly positive at that point?
Just barely. Holding on.
And then this post hits. It introduces fresh, immediate geopolitical uncertainty. Bang.
And it forces this systematic reduction of risk across the board, but especially in those exposed sectors. The subsequent rush to sell futures contracts, particularly in the last 90 minutes of trading, that's what pushed the S&P 500 decisively out of positive territory and back into the red.
Locking in that mixed close.
Locking in that profoundly mixed, highly anxious close. So yeah, that small action, that single post, arguably determined the entire narrative of the day. So if we try to isolate the primary driver of all that volatility, it was undoubtedly the resurgence of U.S.-China trade tensions. This wasn't just some vague macro drag in the background.
No, it felt very specific.
It dictated which sectors survived the day and which ones got hammered. It was all about sector rotation based on geopolitical risk.
And the initial spark, the thing that set futures tumbling overnight, was that specific announcement from China.
Exactly. It came from China's Commerce Ministry, and it was highly targeted. They specifically banned Chinese entities from dealing with 5 subsidiaries of a South Korean shipbuilder, Hanwha Ocean.
Okay, wait. Why did global markets freak out about a South Korean shipbuilder? That sounds incredibly niche, almost random.
It does sound niche, but market analysts immediately understood the signal. This wasn't some isolated commercial dispute. This was seen as surgical economic warfare.
Wow. Okay.
The consensus interpretation, almost instantly, was that this was direct retaliation. Retaliation against recent policy efforts by the Trump administration aimed at rebuilding the U.S. domestic shipbuilding industry.
Ah, so hitting an ally, a partner, to send a message back to the U.S.
Precisely. By targeting a key South Korean partner, China was sending a clear, unambiguous message. They are willing and able to use highly specific non-tariff measures like banning business dealings to disrupt supply chains they see as critical to U.S. national strategy.
So this isn't just about taxing goods coming across the border anymore. This is about actively weaponizing business relationships, cutting off connections.
That's the fear. And you can see the immediate psychological impact, the fear, quantified perfectly if you look at the SIBO volatility index, the VIX.
The market's fear gauge. What did it do?
The VIX data just tells the whole story of investor anxiety that day. It surged by a staggering 15.9% in a single session.
15.9%.
Yeah, hitting 22.04. Now, to put that number into context for you listening, a VIX reading that's consistently below, say, 15 suggests pretty comfortable low-anxiety markets.
Smooth sailing.
Right. But when it pushes up past 20, that signals a real flight to hedging, investors buying portfolio protection. Hitting 22.04, which was a near 5-month high at the time, means investors were actively paying a massive premium for options.
Insurance.
Yeah, insurance against a sharp, imminent market correction. The cost of put options used to hedge downside risk just shot up dramatically.
What's really fascinating, or maybe terrifying here, is how presidential rhetoric, especially social media posts, has become this direct, non-fundamental catalyst. It forces instantaneous institutional trading decisions. We saw the entire emotional roller coaster of the market seemingly dictated by the White House's social media feed over just a few days.
It really highlights the amplification of headline risk in today's market. Think about the sequence. Last Friday, you had a sharp sell-off. Why? Prompted by President Trump's rhetoric about potentially massive tariffs.
Right, the market went into the weekend terrified.
Then on Monday, what happens? The market stages a strong rebound. Why? Precisely because of a seemingly conciliatory post that suggested the conflict would be resolved easily. Something like, don't worry about China, it will all be fine.
Whiplash.
Total whiplash. And then, on Tuesday, the late-day reversal, the one that dunked the S&P 500 back into the red, directly attributed, again, to a new negative post regarding China.
It's exhausting just thinking about it.
Imagine being a risk manager. You might have spent the last 3 hours carefully repositioning your portfolio after Powell's dovish comments, feeling a bit better, only to have a 280-character post force you into maybe a $100 million trade reversal in 90 seconds flat.
Yeah.
That constant back and forth, where the tone from Washington seems to matter more than any verified economic data point, it makes long-term investing incredibly difficult and just keeps volatility cemented at these really high levels.
Okay, so this brings us right back to that core divergence we keep talking about. The Dow finishing up almost 0.5%, while the Nasdaq gets clocked down nearly 0.8%. As you said, this wasn't indiscriminate selling. This felt like highly sophisticated risk pricing in action.
Exactly. The market wasn't just selling the entire U.S. economy, was it? It was surgically selling off exposure to global trade risks, and maybe even buying perceived geopolitical safety.
So we need to look inside the indexes at the components. Why did the Dow hold up?
Well, think about what's heavily weighted in the Dow. It's those large, stable companies, often domestically focused industrial giants, big retailers, companies perceived as being more insulated.
Insulated why? Because their revenue streams are less reliant on these complex, long-haul international supply chains that seem so vulnerable to immediate Chinese retaliation.
That's the perception, precisely. Less direct exposure to the geopolitical crossfire, maybe.
And we saw that reflected in the winners that day. Caterpillar, the huge industrial bellwether, was up a whopping 5%.
Yeah, big move for Teat.
And Walmart, which is almost a perfect proxy for the resilient American consumer these days, was up 5.6%. Huge gain.
And Walmart even had some positive micro news helping it along, didn't it? That partnership with OpenAI.
Right, to integrate a ChatGPT-powered shopping feature. So that kind of blended the durable AI investment theme with this idea of consumer resilience. So a nice little combo.
It helped.
But hang on a second. Aren't companies like Walmart also heavily exposed globally through their supply chains? I mean, they source goods from everywhere, including China. Why was the selling pressure so laser-focused on semiconductors and tech and not more generalized across all global giants?
That is the critical distinction the market was making that day. It wasn't really worried about Walmart maybe having to pay, say, 10% more for plastic toys or T-shirts because of a tariff. That's manageable.
Okay.
The fear, the real fear priced into the Nasdaq, was about the complete existential denial of access to highly specialized, often irreplaceable components.
Ah, okay. Not just cost, but availability.
Exactly. The Nasdaq is just dominated by these multinational technology and semiconductor firms. Their business models require the world's most complex, most sophisticated supply chains, many of which run directly through Asia, and specifically through areas potentially affected by U.S.-China tensions.
So they're the frontline casualties of this specific type of economic warfare, the potential weaponization of supply chains.
That's how the market seemed to view it. And that's why we saw NVIDIA, the darling of the AI boom, slump 4.4%. That's why Broadcom fell 3.5%, and Intel dropped 4.3%.
Despite the AI tailwinds.
Despite everything else, investors were surgically reducing their geopolitical risk exposure by selling these names because their businesses rely fundamentally on components or assembly lines or specialized materials that could be targeted or cut off entirely. That Dow Nasdaq spread. It became the perfect real-time barometer of the U.S.-China conflict playing out that Tuesday.
And this is where it gets really kind of next level interesting. When we talk about the market pricing in supply chain weaponization, it's more than just tariffs. It's about potentially cutting off access altogether.
Yeah, I think we've moved past just thinking about the first-order effect, which is tariffs making things more expensive.
All right.
We've even moved past the second-order effect, which is companies spending money to reroute their supply chains, which is costly and takes time.
Right.
Now it feels like the market, especially in the tech sector, is starting to price in the third-order effect, the possibility of complete denial of access to highly critical materials or specialized manufacturing capabilities. Like, what if you simply can't get the thing you need to build your product?
That's a different ballgame entirely.
Totally different. Look at the semiconductor sector again. Geopolitical headwinds just completely overwhelmed any positive company-specific news that day. You mentioned Broadcom.
Yeah, down 3.5%.
Right. They had just announced a major new AI partnership with OpenAI the day before. Normally, that should have significantly boosted their outlook, right?
You'd think so. Big AI news.
Yet the stock still fell 3.5%. Why? Because the trade risk, the fear of future sanctions or export controls from China or some kind of retaliation, that risk was deemed far more immediate and powerful than the positive fundamental development. It shows how geopolitical risk is now capable of overriding even really good company-specific success stories.
Wow. And the flip side of that coin, the counter-narrative, was the absolutely explosive rally we saw in rare earth minerals.
Exactly. It's the mirror image.
If China threatens to weaponize its near monopoly control over these critical materials, things needed for advanced military tech, for EVs, for magnets,
Everything advanced, basically.
then companies that produce those materials elsewhere outside of China suddenly look incredibly valuable. They become, what, national security assets?
That's precisely the term being used, and it reflects a genuine structural shift in how these assets are being valued. The fear that China might expand its existing export controls on rare earth minerals that sparked this massive, almost disproportionate rally in domestic U.S. producers and other non-Chinese sources.
We saw some huge moves. Critical Metals Core, CRML.
Jumped another 29% that day. Just continued its tear.
And MP Materials, the domestic U.S. rare earth player, MP.
Also rose nicely, up 3.8%. And the key point here is that these companies' valuations are now heavily influenced not just by, the spot price of neodymium or whatever.
Right, not just supply and demand for the metal.
No. It's increasingly driven by perceived geopolitical choke points. Their stock performance is fundamentally decoupling from traditional commodity metrics. Instead, owning them is being treated almost like a hedge against escalating conflict. The market is actively trying to buy assets that are either immune to or might actually benefit from worsening trade conflict. It's a fascinating dynamic.
Okay, so we've established geopolitics as this huge disruptive force. But the other major driver of this fractured day was, of course, the start of the Q3 earnings season. And the key takeaway here, as the sources really emphasize, seems to be that what executives said about the future mattered vastly more than the profit numbers they just reported.
Absolutely. Guidance trumped results. The market is just desperate for clarity in this incredibly uncertain world. And it seemed to punish companies that offered caution, almost regardless of how stellar their recent performance was. JP Morgan Chase is the perfect example, the cautionary tale of the day.
Yeah, JPM. They easily beat analyst estimates, right? Driven by phenomenal strength in their trading desks.
Unbelievable numbers in trading.
Like a 21% jump in fixed income trading revenue, a 33% rise in equity trading revenue. Just fantastic results across the board. And yet the stock fell 1.9%. Why on earth did the market reject that kind of success?
It boils down to who delivered the message. The market respects Jamie Dimon, JPM CEO, almost as an economic oracle. And he didn't just report the numbers. He delivered what felt like a sermon on risk.
Okay.
He explicitly warned of, and I'm quoting here, uncertainties stemming from complex geopolitical conditions, tariffs and trade uncertainty, elevated asset prices, and the risk of sticky inflation.
Wow, he hit all the big fears.
He really did. And that level of caution coming from him was immediately interpreted by the market as a significant warning about future risks. Risks that, in the market's eyes, effectively negated the excellent quarter they just reported. Investors basically decided, well, if Tiamat is this worried, maybe we should be worried too, and they sold the stock.
So contrast that with the company that got rewarded for confidence, Wells Fargo. Their stock surged a massive 7.2%. It was a huge anchor, helping keep the broader market from completely
A
collapsing.
huge outperformer.
They also beat estimates, but as you said, so did JPM. What was the critical difference? Why did Wells Fargo soar while JPM sank?
Wells Fargo provided something tangible, something quantitative that expressed future optimism. They didn't just beat the Q3 estimates, they actively raised their forward-looking profitability target. Specifically, their goal for return on tangible common equity, or ROTCE.
ROTCD, can you quickly explain what that is for listeners?
Sure, ROTCE is basically a measure of management efficiency. It shows how much profit the bank can generate from its core capital, its tangible assets. It's a key metric analysts watch.
So raising that target.
Raising that target, boosting it from a prior goal of 15% to a new higher range of 17% to 18%, that was huge. It signaled very clearly that management was not only moving past some of its past regulatory hurdles like the big one, getting that regulatory asset cap removed,
Right, that was big news for them.
but also that they were supremely confident in their internal execution and their future earnings power, almost regardless of the messy macro environment. That kind of clarity, that commitment to future growth, that's what fueled the confidence needed to overcome all the geopolitical noise surrounding the market that day.
Clarity rewarded. Well, we saw some other important nuances in earnings too, right? Citigroup.
Citigroup was interesting. It rose 3.9%. And the commentary highlighted significant efficiency gains they were achieving by leveraging AI. They actually quantified it, noting they had freed up an estimated 100,000 developer hours per week.
Wow, 100,000 hours.
Yeah. That kind of specific operational leverage metric clearly resonated with investors. It confirmed that, the AI theme isn't just about future potential, it's delivering real, measurable cost savings now for some companies.
Okay. And on the flip side, Johnson & Johnson, healthcare giant, usually pretty stable.
J&J actually fell 1.1%, even though they also raised guidance and reported better revenue. So why the drop? It seemed to be attributed mostly to the structural uncertainty introduced by their ongoing plans to spin off their orthopedics business.
So not necessarily that the spinoff is bad, but just the process creates uncertainty.
Exactly. In an environment that's already hypersensitive to political and economic chaos, adding the complexity of separating a major business unit with all the associated costs, potential regulatory hurdles, execution risks that just weighed heavily on the stock, it shows that structural uncertainty is being punished almost as severely as geopolitical uncertainty right now.
Don't rock the boat, basically.
Pretty much. Keep it simple and clear if you can.
And finally, there was Domino's Pizza. DPZ rose.
Yeah, Domino's rose on strong U.S. sales growth.
Wow.
And while it's just one company, that's actually a vital little data point. Amidst all the doom and gloom about global trade wars and uncertainty, it signaled continued resilient spending by the American consumer, at least on pizza. It provided some fundamental grounding, a reminder that the domestic economy still had some pockets of strength. Now, one of the most significant variables shaping investor behavior on October 14th was something almost invisible, the ongoing U.S. government shutdown.
Right. That was still happening then.
It was. And it created this profound data vacuum. It suspended the release of crucial official economic reports, things like the Consumer Price Index, CPI, for inflation, key employment data.
It's the numbers everyone relies on.
Exactly. And this absence of official verified data makes it incredibly difficult, not just for investors, but crucially for the Federal Reserve, too, to accurately model the health of the U.S. economy. How strong is inflation, really? What's the true impact of these escalating tariffs?
So investors are kind of flying partially blind?
Pretty much. They're relying more on guesswork, anecdotal evidence, maybe outdated figures. I mean, without the official CPI or the non-farm payrolls number, how can you confidently run your risk models or make allocation decisions?
That puts enormous pressure back on the Federal Reserve, doesn't it? How did Fed Chair Powell navigate this? He's trying to set policy, but doesn't have the usual official data to back up his concerns.
Powell's public statement that day was seen as a very clear, very calculated dovish tilt. He was speaking in Philadelphia, I believe, and he said, and this is a key phrase, that rising downside risks to employment have shifted our assessment of the balance of risks.
Okay, shifted our assessment. That sounds like Fed speak for we're getting worried.
That's exactly how the market read it. It was profoundly significant because it signaled the Fed's willingness to potentially act preemptively, maybe ease policy, even without the official confirmation from the jobs data, if they perceived those downside risks continuing to rise.
So reinforcing the Fed put idea again?
Absolutely. This strong statement just reinforced market expectations for future monetary policy easing reads. Rate cuts eventually, and that gave the equity market, especially the domestically focused parts, a much-needed policy backstop during a volatile day.
That backstop maybe gave some comfort to stock traders, but if we want to see how truly nervous long-term investors were feeling, we probably have to look away from stocks entirely, right? Towards the traditional safe haven assets.
That's where the real anxiety was manifesting, loud and clear.
What were they doing?
The flight to safety was just overwhelming and, importantly, sustained. Gold futures, for instance, continued their record-breaking multi-month rally. They held firmly above $4,100 an ounce.
$4,100.
Yeah. And just to underscore the magnitude of this move for you, gold was up over 57% year-to-date in 2025 at that point.
Wow, that's not just a blip.
No, this is not some speculative spike. This represents a massive, sustained accumulation of a tangible asset. It indicates really deep-seated anxiety among major investors about things like geopolitical instability, maybe potential currency debasement down the road, long-term inflation risks stemming from soaring government debt loads. All of it.
And silver was moving too, confirming the trend.
Oh, yeah. Silver surged to a new record high as well, moving above $52.50 an ounce. This powerful, sustained rally in both precious metals is probably the most tangible evidence you can find of investor anxiety about the long-term structure of global finance and geopolitics.
Meanwhile, what about Treasury bonds, the other classic safe haven?
Treasury yields remained relatively steady, actually. The 10-year Treasury note yield slipped just slightly to 4.02%. The fact that it held steady despite all the equity volatility showed there was still very high demand for the perceived safety of long-term U.S. government debt.
Okay, so since the official government data was missing due to the shutdown, investors had to turn to alternative sources, private surveys, things like that. What did those tell us about sentiment on the ground?
They pretty much confirmed the profound unease. We looked at the NFIB Small Business Optimism Index data that came out. Specifically, there's a component within that index called the Uncertainty Index.
Okay.
That Uncertainty Index climbed 7 points in the latest reading to reach 100. Now, a reading of 100 might not sound dramatic, but context is key. That was the fourth highest reading for that specific index in the survey's entire 51-year history.
Fourth highest ever. Wow.
Yeah. It signals immense caution within the small business community, which, is often called the engine of the U.S. economy. It implies things like hiring freezes, delays in capital expenditures, just generalized wait-and-see behavior that definitely threatens future economic growth. So the Main Street view mirrored the Wall Street anxiety.
Okay, so we've painted this picture of a day really defined by this fierce division. On one hand, you have robust domestic corporate performance, strong earnings from some sectors. On the other, you have these unprecedented, unpredictable geopolitical shocks rattling confidence. Let's look at the immediate road ahead now, because the market reaction doesn't just stop at 4 p.m. Eastern.
That's right. The after-hours trading gives us a crucial early signal for the next day's sentiment. And the most significant mover after the bell on Tuesday was Intuit, INTU.
The financial software giant. TurboTax, QuickBooks.
Exactly. They reported earnings and guidance post-market, and the stock plunged nearly 12% in after-hours trading.
12%? Ouch.
Yeah, and it just clearly underscores that this persistent sensitivity to the forward outlook, to guidance, it's not going away anytime soon. Investors are still absolutely relentless in punishing any hint of a disappointing outlook.
And did the sector weakness we saw during the main session, particularly in tech and semis, continue after hours?
It did. Micron Technology, MU, a massive player in memory chips, was down another 3.10% after hours. That just confirmed that the sector-specific caution, the geopolitical overhang, remained the dominant theme for technology and semiconductors heading into the next day.
So looking at the futures market then, overnight, what was the sentiment shaping up for Wednesday's open?
Futures were suggesting maybe some stabilization, perhaps a mixed to slightly positive open, but it definitely wasn't signaling a confident rebound. And importantly, the tech-focused E-mini NASDAQ 100 futures, the NQ, were noticeably lagging again.
Still under pressure.
Yeah, posting only marginal gains compared to slightly firmer gains in the E-mini S&P and the Dow futures. So that just confirmed again, the tech sector's specific geopolitical burden was persisting into the next session.
Now, given that government data blackout we talked about, Thursday's economic calendar suddenly took on this heightened, almost desperate importance, didn't it?
Oh, absolutely. Any data point becomes magnified when you're starved for official numbers. The market was set to laser focus on Thursday's releases: the Producer Price Index, PPI, retail sales figures, and the initial jobless claims number.
Why those specifically?
Well, with no official CPI inflation data, the PPI would be closely watched for any sign of inflation building up earlier in the supply chain. The raw price pressures companies are facing. Retail sales would be vital to either confirm or deny that consumer resilience story suggested by Walmart and Domino's. Is the broader economy seeing that strength?
And jobless claims for the labor market health.
Exactly, a key read on the labor market in the absence of the big monthly report.
Okay, and the earnings calendar was also shifting, moving from the big banks to companies maybe even more exposed to these global supply chain issues.
This is where the rubber really meets the geopolitical road, maybe the most critical input for the rest of that week. Wednesday was set to bring reports from Bank of America and Morgan Stanley, continuing the bank theme, but also, crucially, from ASML Holding.
ASML, they make the machines that make the chips, right?
Effectively, yes. They have a near monopoly on the incredibly complex EUV lithography equipment that's essential for manufacturing the world's most advanced semiconductors. Their commentary on demand, on orders, on any potential disruptions, that would be the first real test of whether these trade tensions were actually starting to affect the core physical ability to produce advanced technology globally.
Huge bellwether then. And then Thursday.
And then Thursday, arguably the single most important report for assessing the real geopolitical impact. Taiwan Semiconductor Manufacturing Company, TSM.
The giant foundry.
The world's leading foundry. They produce chips for almost every major tech company you can think of. Commentary from both ASML and TSM would be absolutely vital in assessing the true physical impact of trade restrictions, not just the rhetoric, but actual impact on the global semiconductor supply chain. If they started signaling production cuts or order delays due to access denial for materials or equipment,
then the tech sell-off could get much worse.
it would almost certainly deepen, yes. Their word carries enormous weight.
So let's try to synthesize all of this. What does it mean for the strategic outlook? If you had to lay out the bullish versus the bearish cases that were fighting for dominance in the market at that moment, what would they be?
Okay, the bullish case, I think, remained firmly rooted in a few core strengths. First, that resilient U.S. consumer, evidenced by companies like Walmart and Domino's still doing well. Second, the enduring, maybe even accelerating AI growth story that continues to power companies like NVIDIA and Broadcom, despite the short-term geopolitical headwinds. That's a long-term structural driver.
Okay.
And third, you still had that supportive Federal Reserve policy, backstop Powell, signaling readiness to ease rates if the economy truly weakens. That provides a floor of sorts.
Seems like a decent bull case. But the bearish case feels pretty formidable too, and it seems centered almost entirely on external, unpredictable factors.
That's right. The bearish elements are almost all about uncertainty. First, the sheer unpredictability of geopolitical escalations, how a single tweet can erase multi-day games in an instant.
Right.
Second, the macroeconomic picture being obscured by that data blackout, forcing everyone to make decisions based on incomplete or potentially faulty information.
Risky.
Very risky. And third, the widespread cautious tone coming from so many corporate leaders like Jamie Dimon, who are seeing strong current results but still refuse to commit to overly optimistic guidance for the future. That caution weighs heavily.
So volatility seems like the main takeaway. It's the key word, isn't it? What's the strategic advice then for the listener trying to navigate this kind of environment?
Yeah, volatility is almost certainly going to remain elevated, and it's likely going to be driven more by the news cycle, headlines, tweets, geopolitical events, than by the quarterly financial reports themselves. So investors are probably advised to stay nimble, stay flexible.
Makes sense.
Maybe focus on companies with strong domestic exposure, perhaps less tangled in global supply chain risks. And critically, look for management teams that project clear, confident forward guidance, like we saw with Wells Fargo. Clarity is being rewarded.
And what about protection?
Hedging. Well, the continued undeniable strength in assets like gold and silver suggests that maintaining some portfolio hedges against unforeseen geopolitical shocks isn't just prudent anymore. It might be essential for survival in this kind of unpredictable environment.
That seems like very sound advice. So the core lesson from this deep dive into October 14th is really that the market right now is rewarding clarity above all else and punishing uncertainty, sometimes almost irrespective of how good the recent quarterly numbers actually were.
I think that's fair. And what's truly fascinating here, maybe a final thought for you to ponder. Consider the simultaneous sharp sell-off we saw in U.S. semiconductor stocks that day, alongside the explosive sustained rally in U.S. rare earth mineral stocks.
The contrast.
That contrast demonstrates, I think, a fundamental, maybe even structural shift in how certain assets are being valued. Geopolitical risk is no longer just some vague macro drag affecting everything slightly. It seems to be actively creating and validating a brand new class of what you might call national security assets.
Assets whose value is tied to conflict probability.
Exactly.
Yeah.
Their pricing seems increasingly dictated by the perceived probability of conflict or supply chain weaponization rather than just traditional PE ratios or discounted cash flows. It's a whole new dimension to valuation.
That's a really powerful idea to end on geopolitical risk becoming an asset class or at least a primary valuation factor unto itself. It means, for you listening, you really need to monitor the rhetoric, the tone coming out of corporate boardrooms and global capitals this week. Because clearly, as we saw on October 14th, the tone might matter far more than the official data itself right now. Thank you for joining us for this deep dive.